one nation under God, indivisible, with liberty and justice for all.
Thank you. As we're all aware, we have a cell phone policy. The Board of Directors has initiated the following policy. If your cell phone rings, you must pay $25 to RPAC.
What's your number?
If you answer it, mine's already turned off though. If you answer it, you must pay $50 to RPAC. Education sheets are on everyone's table. Please remember to print your name on it so that Melissa can read it. At the end of the meeting, hand your sheet to Melissa. The sheets will only be taken today, and only one person per sheet, no exceptions. Today we have my new friends that I just met from Terry, Lockridge, and Dunn talking about tax strategies. They are Rhonda Andrews, Barry France, and Mike Mesh. Welcome.
Welcome. Can everybody hear me? I don't really feel like holding that thing, so thanks. My name is Barry France. I've been with the firm, Terry, Lockridge, and Dunn, for about 10 years. So it'll be my 14th tax season upcoming. It's better with it off. That works?
That'd be a little higher.
So where was that? We set up this presentation into 3 sections. I'm going to take the first section, and Mike's going to take the second, and Ron will have the third. One of the things with this is the first couple of sections are basically ways that you can help advise your clients. That the third section of Ron is going to help you out personally with some of your realtor self-employed deductions. So what I'm going to cover here is homeowner tax deductions, or I guess tax deductions for the purchase and sale of real estate. Most of you pretty much know these things already, but I'm gonna go over them anyway. When we get to Rhonda's part, there's going to be some wiggle room and some gray areas. This section, there really isn't. These are cut and dry code sections. It is what it is. You can deduct it or you can't. There's really no two ways about it. So we'll start off with origination fees and points. And this is when you have a client who's purchasing a primary residence, and it's very important to know what they're going to do with the property they purchase. If it's an investment property, or if it's for their own primary residence purposes. IRS will care, banks will care based on how you get your lending. When you do purchase a real estate, obviously you've seen hundreds and hundreds of these HUD settlement statements, and I just noticed last year they've changed them a little bit. They used to be pretty straightforward with where the deductions were. Last year I noticed they're doing something with the origination fee and points, which is where we're starting here. They'll give you, and I can't even tell you specifically. I should have brought one with me and put it on the PowerPoint, but it'll tell you that these are your fees that you paid, and then it'll say a portion of this will be your origination fee and points. So you kind of have to work backwards now to figure out what that is. But in a purchase of a primary residence, you can take those points in that year of purchase, and that's on a purchase. We don't really need to talk about refinancing. But in a refinance, it's a different situation. These origination fees and points will be either discount points or a fee charged to you by the lender. We'll go to mortgage interest now. Obviously, mortgage interest is deductible on Schedule A. It's one of your itemized deductions. And let me back up too. So I'm going to keep this informal. So I see a lot of familiar faces, and if anybody has any questions in the middle, just raise your hand. We'll go from there. But with mortgage interest, it's always been a deductible item. If you have a very high income taxpayer with a high valued property, the rules change a little bit. Those are some specific situations, so you'd want to consult a tax advisor. I'm not sure if many of you are aware, but you can only deduct mortgage interest on up to $1 million of debt on a first mortgage. If you get over that, you just waive the right to deduct the mortgage interest. You could obviously still have a loan for more than $1 million, but but that's all that's deductible. And to get more detailed with you, which Rhonda told me not to do, if you have a second mortgage or a second home, you could have another $100,000 of debt to take mortgage interest. So once you get over 1.1 million of debt on the books for 2 properties, then you start losing that tax break. Mortgage insurance. So this started after 2006. Contracts after 2006 of mortgage insurance, and I'm sure you all know what that is a deductible expense now. However, it's very narrow. I shouldn't say very narrow. There's a limit. There's a limit of your adjusted gross income. Once your adjusted gross income is $100,000 or more, as married, filing, joint family, you cannot deduct the mortgage insurance premiums. That's $50,000 for a single. So yes, you can deduct it, and I get that question all the time, but it's limited. So that's really basically like, what you need to know is it's limited, but it is deductible. Moving on to some others deductions. Real estate taxes, obviously, have always been deductible. One thing to watch out, a lot of my clients miss this. In the year you purchase that residence, right up there on the HUD, you're going to get a proration of taxes paid by the seller. Essentially, they're basically putting money in your pocket to pay the taxes for that year. So what you need to do to be correct on your tax return is you need to take the payments that you made in real estate taxes throughout that year, or that were paid on your behalf through escrow, and reduce it by that credit. And this is if you're the purchaser. Most people just think, well, if their taxes are paid out throughout the year, I get to deduct them. That's not right. They're probably taking more of a deduction than they should. They need to reduce it by that credit. And sometimes that credit carries into the next year. So that's something, little known fact. A lot of people miss that one. The last part here about someone purchasing a primary residence, once you own that residence, they do still have the residential energy tax credits available. These started in 2006, and it was a 2-year plan IRS set out there that ended in 2007. But basically, they're letting you have a credit for purchasing something that would improve your residence that would be energy efficient. That was finished at the end of 2007, and then in 2008 they said, well, that was a pretty good idea, so let's do that again for 2009. So ever since the beginning of 06 through now, there are residential energy credits unless it was something that happened in 2008. So it's been extended to 2011. The 2011 rules are these. You get 10% of the cost of qualified property up to a maximum $500 credit. If you've taken residential energy credits in the past, it has to go against this $500. So the limit in 2010 was $1,500. If you had a credit of $1,500, and then this year you have one of $500, you can't take any of it. If you had one of $300 in 2010, and you have one this year, $200 this year you could take. So that's where we are with residential energy credits. Now we're going on to selling a residence, selling a primary residence. Just a couple of points here on deductions you can take. That same real estate tax proration that I talked about a little bit ago works in your favor when you sell a residence, because you're on the HUD, you're giving that proration of time of taxes to the buyer, and so essentially in that year you sell a residence, you're going to double up on your property taxes as an income tax deduction. So it works to your favor in the year of sale. The question that's asked over and over, do I have to pay on gains for my residence? No, you do not. There's been an exclusion, a section, they call it the Section 121 exclusion, for a number of years that's been into law. And what that says is that if you do have a gain on your residence, and let me back up here and let you know, gain is basically the selling price less what you paid for the home, plus any improvements, any closing costs, or what that you did not deduct, painting, whatever, anything to improve your home. That's your basis. So you can usually build up enough basis to wipe out any gain anyway. But if let's say you do have a gain, every taxpayer gets an exclusion of $250,000. If you're married, that's $500,000. So it's pretty narrow to ever pay gains on a personal residence. I've got to tell you, I get these political emails from friends and acquaintances, and I'm sure you all get them, and I'm not going to talk any politics up here, that's not my point. So, but I get them, and I usually just hit the delete button and kind of move on, and I'm just kind of on this list. Well, one day I got one about, it said something about, we're going to pay capital gains excise tax or surtax on our, if we sell our house, that's ridiculous. So here I opened it up and read it, and what they were referring to is this Healthcare Reform Act was passed in March of 2010. It is true, there is going to be an excise tax on gains, but it doesn't start until 2013, so it's way out there. You'll hear more about it next year, I'm sure. But, so what I did was I gave him like a 2-page, I put my accounting nerd hat on, I gave him a 2-page dissertation on the law, and I said, you know, yeah, you're right, if you have over $500,000 of gain, if your income is over $250,000, then yeah, you'll pay, 3.8% excise tax on that. And so, hit send, and I think that's the way to get off those lists. So I've never seen I guess the last part I'm going to talk about is if you're purchasing an investment property, I guess a rental. And this is good to advise your clients because I've known many realtors over the years. They're also real estate owners and rental people because they own these properties and they want to rent them. You basically, this rental, it's an activity where it's passive activity to almost all people. So when I call it a passive activity, I guess I'm not even going to go there with you on the tax side of passive or active, but it's like a mini, I want to say a mini business, if you will. You have to think of it as any dollars you put into that business, into that rental, that are for that rental are deductible. So, I mean, there's a couple of differences with the closing costs. The origination fee and points and such that you could deduct on your primary residence. Here, you need to amortize them over the life of the mortgage. So some of the costs actually will increase your basis in the property, but for the most part, if it's a cost within the HUD to obtain a mortgage, that has to be amortized over the life of that mortgage. So you get a little bit of a benefit, but it takes a while to use it up. Obviously, depreciate the property, 27.5 years of depreciation on a residential rental, 39 years if it's commercial rental. So you'll get that deduction over the years. And when you do that, you need to come up with a split of the building and the land. It might not be perfect, but you could get pretty close. Land you can't depreciate, building you can. Mortgage interest obviously is deductible, along with other interest. If you have credit card interest for some repairs you made, put on a credit card, or if you have installment interest on a tool, or a mower that you use for that place or whatever, that's all deductible. And finally, some of these other expenses. Real estate taxes, you still have that same proration, insurance, utilities, repairs. A couple I jotted down that aren't on here. Auto travel, if you're the person that does the mowing, you drive to that place, every week, mow it, take your mileage. If you have someone managing the property for you, management fees are deductible. Yeah, so basically anything you pay on that property, you should keep track of. It can either be added to the basis or expensed. So. That's all I have on homeowner tax deduction. Any questions before we move on? No? Okay. All right, then I'll hand it over to Mike.
I told Rhonda I'd hold mine to 5 minutes so she could have the rest of the hour. Watch that pretty close. Thanks for letting me be here. We really do appreciate it. I understand you guys are kind of mandated to be here to a point. You got to get your hour CPE in, but hopefully we can make it worthwhile. What I'm going to touch base on today is something that might benefit you when you're working with your clients. When should your client contact a CPA, or when should they contact us, hopefully? Of course, we're going to say always. Our clients, any of our clients that we work with, we like to keep in touch with them throughout the year. We like to know if they're buying or selling their house, moving. What are the things that might, have a tax impact? We We also do a lot of wealth planning, so we try to help them work through those issues as well throughout the year, and perhaps this plays into it. Barry touched on a few things that I will go into just a little bit further, and I'll touch on some other things as well. But you know, one thing that a lot of our clients use, our firm focuses a lot on the realty side of things. We have a lot of clients who invest in real estate. We have a lot of realtor clients. So we have kind of a niche specialty area here. And you know, a lot of realtors have the inside scoop on real estate when it's coming due. They know when there's a good buy. You're just smart investors in that sense. And so what we do with them quite often is help them utilize a 1031 exchange. If you don't know what that is, essentially it's a great way for someone to build wealth through real estate. So if you start out small, perhaps right out of college, we have quite a few clients that have done that. You invest in a rental property, you end up getting to a point where you're making some money on it finally, and you know it's cash flowing well, and you want to move up and invest in something bigger and better, and hopefully grow your wealth that way. You can do a 1031 exchange, which is a tax-free like-kind exchange. So you have to buy like property, and any gain, let's say you purchased the property at $100,000 and you sell it at $500,000, you are deferring that gain essentially forever if you hold on to this next piece of real estate forever. And you can just keep doing that, just keep growing your wealth that way and deferring the taxes on that accumulation of wealth. And the good benefit of this is that you know, obviously you're accumulating wealth, you're accumulating hopefully equity in these properties, and you can utilize that equity to even make your wealth even greater by remodeling or whatever it might be to that property. There are a lot of hoops to jump through with the 1031 exchange, so you definitely want to make sure you talk with an accountant and work with them. We've got a specialist at our firm that knows and has done every sort of 1031 exchange that you can do, and there's some interesting new stuff that you can do as well with it. Just real briefly, you have to, by the time you sell your house, you have to have identified some properties, some replacement properties. You have 45 days then from the closing to identify that property exactly, and it's on the dot. If it's a Sunday, you have to have identified it by that Sunday. You don't get the weekend. And then you have 180 days from the date of closing in order to close on that new property. So you have time, but there are the hoops to jump through, and if you miss it, then all the taxes are paid. The other piece of it is you have to work with a qualified intermediary to handle all the cash. You can't take any of the cash personally. So that's what a 1031 exchange is. Also dealing with residential cooperatives now. I presume that it's a buzz with you guys, the Krupp case that happened this summer, which is a Iowa Supreme Court case that came down that said that multi-unit residential rentals can be, if organized properly, can be called a co-op and therefore qualify for residential property tax rates. This is huge to a lot of our clients who own, excuse me, who own residential rentals, especially. It's got to be a multifamily unit. And essentially what you do is you pay about $2,500 to $4,000 maybe to an attorney in order to go through the paperwork. You have to have two owners of the property, but it's usually, say it's an LLC that you've created, an entity that you've created, and then yourself. So you don't have to necessarily have a partner, you know. You can do it and still be the whole owner. You know, generally you own it with your wife or your spouse or whatever it might be. But, you file a separate tax return for this entity, and automatically you qualify for 50% reduction in your property taxes. It's awesome. It's amazing. It's a lot of cities obviously don't love it. You could always do this with condoizing or condominiumizing your property before, but it was even more hoops to jump through to do that because you have to bring properties up to code before you can condominiumize it. And this, with co-ops, you don't have to jump through that. So it's becoming much easier, and the benefits, as you can well imagine, is more cash flow. And then if you have more cash flow, you all know that rental units are valued based on their cash flow. And if you've already qualified as a residential rental, reducing your property taxes, you're likely to have the value of that unit go up as well. So very minimal costs up front. The annual fee usually to file returns for this might be $1,000 a return, maybe not even that, you know, depending on how complicated it is. And you want to have a different co-op for each property that you have. So if anyone has questions about that, feel free to talk to me or us afterwards. And then a short sale. Hopefully you guys haven't had to deal with too many of those with your clients. But it's been, I'm sure, more and more. Just kind of the general rule there is if it's your residence that you live in, as long as it's qualified residential home mortgage loans, then those are tax-free debt forgiveness through 2012 at least. So they don't have to worry about paying taxes on that. And in a lot of these situations, you may not have to pay taxes anyway because that taxpayer might be insolvent and essentially owe more debt or much more debt than they have assets. And that's another way of sometimes getting out of that cancellation of debt forgiveness. If there's an investment property, or one of your clients have an investment property that you're helping to move, obviously they want to get a good idea of what their basis is in that property because there will be a taxable gain on that sale in general. A lot of, I think, taxpayers leave money on the table with regard to their basis. They don't spend much time calculating a basis schedule, which again, as Barry said, is, you know, your purchase price plus any money you've put into it that you haven't been able to write off over the years. We've got a lot of ideas. We can work with clients really easily and quickly and come up with, gosh, I mean, sometimes it's $10,000, $20,000 of additional basis that they just don't think about when they're reporting their taxes for the sale of their investment property. Some of you may have a home office, or some of your clients may have home offices, and in that instance, if you happen to be depreciating a portion of your home to get an extra tax deduction, anything that you depreciate can be picked back up as income when you sell the property at a rate of 25% tax on that. So that's just something to be aware of, that you should let your clients know as well, to talk to us about that so we can help plan. Usually it's not going to amount to a lot of money unless you've been in that house for years and you got it fully depreciated, but it's so rare, you know, that that's the case, but it's definitely something that needs to be recorded. One other thing that Barry touched on that I'll touch base on real quickly is the 121 exclusion, he called it. So if it is your personal residence and you're selling it and you've lived there 2 years, then you do not have to pay taxes in the first, and you're married, you don't have to pay taxes in the first $500,000 of gain on the sale of your personal residence. If you haven't lived there 2 years, then you may have to pay gain. But there are questions to ask. There are ways around that. There are certain rules that will allow you to get out of paying that tax as well. One example being that if you, and I forget the exact mileage, but if you move a certain distance from your job, or if you, how does it work? If you switch positions
Relocate.
and it's within 50 miles or 100 miles, it's one of those, then you can get out of paying the tax because it was seen as kind of an unforeseen circumstances. There are other things related to, you know, medical issues and things that you want to think about. You want to at least ask the question when you're working with your accountant.
Yeah, I failed to mention that 2-year rule. You'll see that a lot with contractors, construction clients. They'll build their own house pretty cheap, at their cost, and then they'll live in it for 2 years, and then they'll sell it, and that, they kind of do that every 2 years. So that's where you see that 2-year thing come into play quite a bit. You always want to ask that question.
So that really, I think, covers my piece, unless there are any specific questions on anything that I discussed. Yeah.
So if a person who is relocating to Cedar Rapids, maybe a little shaky in that they think they're gonna be here 2 years, sometimes they'll say, geez, I don't necessarily want to buy a home. If they did buy a home and were then relocated for work beyond 100 miles, they would potentially
Yeah.
be able to take 2 in less than 2 years then?
Right.
It even goes further than that. There's situations, a change in family status will qualify. So if somebody gets remarried or divorced, there was a case where somebody had triplets and they had to move to a larger home. And those cases have gotten through the courts as well. As long as there's a reasonable circumstance to the move, the IRS has been pretty lenient with it. I can't say, well, go, for every situation, but there has been some really favorable court cases out there.
On 1031 exchanges, the example you gave, 100,000, they put up to 500,000. The elimination of the capital gains tax is based on the 400,000 or a percentage of the 400,000 when they roll it over.
When you roll it over, you essentially roll that 400,000 equity into the new property. So you have that equity in the new property, but you're not paying tax on any of that.
Okay.
Does that make sense?
And at some point, you're gonna have to pay tax, right?
Unless you die with the property.
You are
Then you get
deferring
stepped
it
up.
until you get rid of that last property.
Right.
But then you put it in a CRT, charitable remainder trust.
Sure.
Yeah. Yeah. Or if you die with it, it goes to your kids, they get your date-of-death basis, so they would pay no gains.
Okay.
With some other estate limitations, of
Yeah.
course.
All right, well, we'll be around for more questions at the end.
Did you take over 5 minutes? How much you really couldn't. Mary got stuck talking about the stuff that's just black and white. A few of the pointers to help your clients with. But if you can remind your clients, especially the ones that are selling, to look at their HUD statements and pick up those property taxes on the year of sale, you just reinforce that client relationship and maybe you've generated additional referrals out there. So just a little bit of that knowledge can go a long way. Mike touched on some of the, really unique situations where you really want to say, hey, you should probably talk to somebody to make sure you're getting all the tax benefits you want. Now, I get to talk about the fun things. What can we deduct on your tax return? What Barry said is black and white. What Mike said is black and white. My area, there's a little bit of gray. There is some interpretations of tax laws. There are different attitudes on how aggressive you are. We've seen some favorable cases coming through in some districts. We've seen some unfavorable cases coming down in other districts. So I'm going to touch on some very basic deductions, and then I'm going to go into a few other unique ones. It's fun. Every year I talk to my clients and I end up coming up with something new every year they ask about. There's always something new out there. I remember the year I stumbled upon everybody was getting a new digital camera. I'm like, use that to take pictures to email your clients. And all of a sudden we generated another tax deduction that I hadn't been thinking about later on. There's always something new coming out. So the list of deductions just grows every year. And where I come up with my list of deductions is from talking to my clients. So one of them that they give us every year is our auto expenses. You guys are all familiar with them. You've probably all talked to your accountants about your auto logs and tracking your auto expenses. And we have 2 options we can go with. We can go with the standard mileage rate. That is probably the easiest when it comes to record keeping. We track how many miles we drive, and we apply it towards the IRS rate for the standard mileage rate. For 2011, they are giving us 51 cents for the first half of the year and 55.5 cents for the second half of the year. My clients tend to think that it's a function of what it really costs to run a vehicle. Has nothing to do with it. It's a budget. It's a budget issue for the government. They look at what they need in their budget and they adjust the standard mileage rate accordingly. Or if they're trying to stimulate the economy, they'll actually increase the standard mileage rate. So often I'll hear, but the price of gas went up and the standard mileage rate went down. They really have nothing to do with each other. So for most of the cars out there, the majority of the cars out there, the standard mileage rate is probably the easiest and probably the most advantageous, unless you're driving a sports utility vehicle or a larger vehicle or a very expensive vehicle. It's a case-by-case situation. I can't give you a dollar amount. We look at how often you trade your vehicles. We look at how many miles you put on a year, and we look at it on an individual basis. But it's something you should really look at. The trouble with the actual expenses is you have to keep every little receipt. You have to track every expense, every receipt. Standard mileage rate, much easier. You just keep your log and keep track of your mileage that you're driving. But even with the standard mileage rate, there's things that aren't included. If you're taking the standard mileage rate and your accountant has not asked you how often you wash a car, make sure you tell them. Those car washes are deductible over and above the standard mileage rate. Any little features that you add to the car, if you get new floor mats or something like that, those are deductible over and above. We always tease, did you buy new dice to hang from the rearview mirror this year or something? Those little things are deductible. So don't forget about those. I know it sounds silly, but a car wash actually adds up. You guys are on the road taking clients out. You have to wash your car probably almost every week, unless you're like me. But it really does add up. And even if you don't have a receipt, keep it in your mileage log. Just make little notations in your mileage log about how often you're washing that car and add that to your tax return. Those little deductions really do add up. So the next item on the list is the cell phones. Everybody knows about the family packs of cell phones right now. So I have a client that comes in and says, yeah, I have a cell phone package, but I have 5 phones on it, so I'm only taking 1/5 of the cost of the package. That's not right. You as the self-employed individual should be the primary phone on the package. So you probably got that package for $150 a month for the first phone, and each phone over and above that is $25 each. We can't take the $25 each for each of your teenage daughters or sons' cell phones, but we can take the primary phone cost, the $150 on your cell phone. So make sure you're not shortchanging yourself with these deductions. It's really, really important. And if you have that teenage son or daughter answering some calls for you, or scheduling appointments for you, or working part-time for you, go ahead and take a small proration of their cell phone as well. They're actually helping you with the business, which is something I'll touch on a little bit down the road. So I'm going to migrate to home phones. I know a lot of people don't have them anymore, but for those of you who do, since you're in the business of working with the public and getting your name out there, the cost of the primary line into your home is not deductible. But if you have call waiting, caller ID, or a second line into your house, those are completely deductible. We just can't take the cost of the primary phone line, but we can take all those add-ons. So all these things seem little, but when you start to pile them together, it does make a difference on your tax return. Meals and entertainment, always a fun one. I always laugh. I have 2 types of clients. The ones who want to deduct thousands and thousands and tens of thousands of dollars in meals and entertainment, and the ones that go, nope, that's a red flag. The answer's somewhere in the middle. When you're out with your clients, absolutely deductible meals and entertainment. But also think about the people that you're meeting. If you're meeting somebody new in town and you're talking about what you do, that's a potential client. That's a deductible meals and entertainment expense. If you are out networking with other realtors that you're hoping to get business with, absolutely deductible meals and entertainment. If you're out with friends, but you really spend a lot of the night talking about what you do, those are potential referral sources, meals and entertainment. Don't be shy on taking those meals and entertainment. The IRS expects to see them. You're self-employed. You're networking yourself. They expect to see that meals and entertainment on there. Now, if you take your son or daughter out for the birthday, not meals and entertainment. But when you're out with somebody, just jot down who you're meeting for dinner, for lunch, whatever you're doing, and they're always a wealth of potential referral sources. So, just work into the conversation what you do, how business is, how you're looking for new clients, and you just generate a meals and entertainment. So don't be shy on taking them. but just be smart about what you do take.
Question?
Yeah,
You were talking about cell phones and home phones. Can you, if you have a home office, can you take a portion of the internet bill?
oh, the internet is 100%.
Okay.
You have to have that internet at home for your home office.
Okay.
You absolutely cannot do business anymore at your home without the home internet. So I always take a chunk, I use MediaCom, I take that chunk of that MediaCom bill. I think that one isn't even going to be questioned. There was a while there where they wanted us to prorate between business and personal use. Well, it's now a necessity. More and more people are working out of their home. I don't even think it's going to be questioned in the future.
Can you take a portion of your country club dues off?
Mm-mm. You can do the meals and entertainment that you pay there, over and above what your set fee is, but you cannot do. Country club dues, athletic suites, athletic tickets. Tickets, we have a little gray area to work with, but like how they used to, people would buy athletic suites and send their clients to it, those have all been shut down. And country clubs were shut down too. So, that is one of the areas that kind of got abused, and so the IRS just closed the door on it.
Have many of your clients been questioned or asked for review from the Iowa Department of Revenue, right now looking for revenue?
Iowa Department of Revenue is insane right now. And I hate to say that. If you have clients, I don't know how many of you are familiar, I'm sidetracking, I apologize, but if you have clients who have taken the Iowa capital gains exclusion, it's a great option. If you have a client who used a building in Iowa for their business, or they owned a rental property in Iowa that they never had a management company for, and they have owned it for 10 years in Iowa, when they sell it, they don't have to pay any Iowa tax on it. It's the Iowa capital gains exclusion. Huge benefit right now. Every one of my clients who took it in the last 3 years has gotten a notice. They are just cherry picking deductions and blanketing notices. Anybody who's taking it is getting blanketed with notice. I hate to say this, but I think they're just hoping that some retired couple that is scared of the IRS or the state of Iowa is just gonna write a check. But yes, we're getting a lot of notices from the state of Iowa, and especially some of the deductions that they gave us, but just everything. And they're also looking for out-of-state income. They're getting aggressive on out-of-state income, and we're only going to see more of it as the budget crisis worsens. So, Marion?
Yes, if you have a desk at the office, but also an office at home, can you take your home office?
I'll be touching on that in just a little bit with the home office, okay? Anything else?
Are you seeing pushback for agents that use an assistant and try to treat them as an independent contractor from the state? Because it seems like the state's really clamping down on what really is an independent contractor.
It's not the state as much as the IRS. The IRS is starting to go after the independent contractor. When you're hiring somebody, whether you're hiring them as an independent contractor or an employee, know the rules. It's a big thing. If you do your homework first, you can get around it. But yes, it's getting questioned, but it is so expensive to have somebody as an employee that if you can find the right individual that will work in the parameters that you need, the independent contractor still flies. Okay? Let's see here. Had to remember what slide I was on, sorry. This one's pretty easy. Your travel expenses, going to CEUs, continuing education courses. I do have some clients who, when they are out of town and just locales and stuff, they check out other real estate offices. We can do a proration between business and personal as long as you work into some of your business expenses while you're out of town. It's always good to see what the competition's doing. It's always good to see what the market's doing elsewhere. So keep track of those travel expenses. Gifts are kind of a sticky subject. Gifts are limited to $25 per client per year, unless it's something with your name on it. So if you're buying a gift for somebody that you sold a home to, try to keep it fairly small. Now, if you're selling a $600,000 or $700,000 home, you're not going to buy a $25 gift. One of the ways we can get around that is we actually throw them in with closing cost. Generally, something to ensure the close of a deal is deductible. So if we can group some of those larger items that you buy, if you close up on a large home and you're buying something to reinforce that goodwill and make sure that closing is going to go through, we reclassify those gifts from the gift category, which is a red flag on the tax return, to closing cost. And we have not ran into any problems with it in our history with the IRS. So it's one of those little things where presentation makes a big difference. It really does, because gifts, I don't know why it's kind of archaic. It's been set at $25 for, I've been working for 18 years, and it was $25 when I started 18 years ago, and I don't know how far back it goes before that, so. That's something to think about. Advertising and promotions, I don't have a lot to say because you guys all pretty much understand what advertising and promotions is. But I hope all of you understand why a deduction on your real estate income is a better deduction than just on your tax return, because you save the self-employment tax with it. Does everybody kind of know when I'm talking about you're saving the Social Security and Medicare that you're paying for it? So if you're going to do a donation to Big Brothers Big Sisters, instead of doing a donation, sponsor one of their activities. And get, I'm going to pick on you, Joy, because I know you. I'm going to pick on you and say, sponsored by Joy Cipher Realtor. That just took it from a contribution on your Schedule A, where you're going to just save your normal taxes, and moves it onto your realty deduction schedule, where you're going to save the self-employment tax. Moving that just saved you 15.3% on your tax return. Okay, so anytime you're thinking about doing a charitable contribution, think about, is there some way, you're still doing it for the right reason, but you know, if you can get a bigger tax savings on it, it just means more money to give to the organization in the future anyway. I'd rather give the money to a charitable organization than the government, so. Anyway, that's one way to go about advertising and promotion, is just rethinking your charitable contributions and how you can actually get your name out there. Okay? Dues and license, those are pretty straightforward. Everybody has their realtor dues, everybody has their Cedar Rapids, AAR sheets that come through, but don't forget about the other organizations that you belong to. Country clubs won't work, but if you're belonging to the Home Builders Association to meet some contractors, or if you're belonging to other organizations out there, those dues are just as deductible. Anything that you're going out and networking with people, trying to meet additional people out in the community is deductible. So, continuing education, that one's really straightforward. Commissions, that's what Joy was just talking about. Don't forget though, if you pay somebody over $600, to be sure to give them a 1099 at the end of the year. That is your responsibility. The fees, or the penalties on it is very low, but if you can get that 1099 out there, it just secures the deduction for your tax return in the case of an audit. So just a good idea to do. E&O insurance, it's just one that people tend to forget. I think it went from being paid every year to being paid every other year, or something for some people. I don't know, but it's just one I keep seeing my clients forget the last couple of years, so I just threw it on there just so you remember to keep track of your E&O insurance. The next item is the home office, and that's what Marion asked about. The rules for home office used to be very stringent. If you had a desk somewhere else, you could not take a home office deduction. They have been lightened up the last couple years. The rule that I like is if you have an area in your home that you use regularly and exclusively for your administrative or management activities, it now qualifies for the home office deduction. That means you need to do your paperwork at home, in that space in your home. When you're at your office, that's where you're making your phone calls, that's where you're making your client contacts. But if you do your paperwork exclusively in your home office, you just generated a deduction to take the home office. What I like about the home office is it not only gives you the deduction for some of the business uses of your home, but it makes a lot more of your travel time deductible because you're going to and from workplaces. So it actually transfers some of your commuting to deductible business expenses. Okay? Did that help, Marion?
Yeah.
Okay.
And how do they calculate the portion of electricity, et cetera?
Square footage.
Square footage?
Square footage. And the one thing I always tell the person, if you're deducting a car on your tax return, which you should be sure to take that square footage of where you park your car in that garage. So, because that's a business vehicle you're parking in your garage.
Do any of your clients ever have trouble getting a loan?
Getting a
I'm just
loan?
thinking of looking at tax returns that all show negative income every year.
No, my clients don't usually. I work with them. We don't deduct everything. I don't want you to think that. I'm just trying to get you to think differently about deductions. I have so many clients, especially young ones starting out, that come in and they're scared to deduct anything, and these deductions are in the code for you to take. I just want you to think about what's up there, so, yeah.
I'm actually a lender, I was just.
And you're talking about that, then services from, for your work as an accountant are deductible, correct?
Absolutely, absolutely.
What if you have two separate businesses, a home office and an office? Is there a different amount you can take off your home office?
Oh goodness, there's special rules on that, and I apologize. I know we can do it, but there's special hoops we have to jump through. If I could get your name, I can look it up for you, and I just don't know that one off the top of my head, but.
You can't double dip on a home office. If you're taking the full effect of the home office on one business, you can't take that same deduction on the second one. Does that
But are
make
you
sense?
talking about an office off-site as well, or are you talking
Well,
about?
I have an office at the office, plus I have an office at home.
Okay, but do you do different activities out of the two offices?
Yeah.
Oh, yeah, you can take, yeah, you're okay there. Absolutely. Okay, so home office is one of those things. To kind of go with your lending question, a home office can't make your income go negative. It'll take it down to zero, but it won't make it go negative, so.
That doesn't help
Oh, funny. And I just wrote down a few other miscellaneous expenses that we have that I kind of like to work with. If you have a child under 18 and you are a Schedule C tax return, a sole proprietor, you are not incorporated, but you're a Schedule C, a child under 18, you can hire to put up signs for you, do advertising, hand out flyers, attend open houses, whatever you need he or she to do, and you do not have to pay them payroll taxes. So it's a great way of deferring income. Here's my favorite part of this. So you have a child who's 15 years old, responsible enough to go out and really help you. Maybe they're cleaning your office. Doesn't matter what they're doing. You pay them $3,000 during the year. Then you twist their arm a little bit and you say, go put that $3,000 into a Roth IRA. So you have somebody making a Roth IRA contribution at the age of 16. A Roth IRA grows tax-free until they're ready to retire. That is one heck of a way to get your child to start saving. One heck of a way. That only works if you're a sole proprietor, Schedule C tax return though. The minute you're incorporated, you lose that ability. So, but that's one of the planning techniques I like to use.
That I needed, but what about farm children and farmers? Did they, they put the kids to work?
Yeah, not my area of expertise.
Yeah, this is- yeah.
I think it's the same
If
thing.
they're
I
under
don't
that
work
age.
with many farming clients.
Until they're 18, you can handle it that way.
Until they're 18, I
But
think.
there's a level. I mean, it's $5,700. It's the standard deduction level. So up to a certain level of what you're paying them, yes, there's no
Well,
payroll tax.
they can be paid up to like $5,700 completely tax-free where they will not owe tax liability on it. But if you go over that, they'll pay tax at their level. So it's still a good income shifting technique. Yeah,
How about a 15-year-old grandchild that lives with us?
it doesn't. I love all these specific questions. I wish I knew all of them. I don't think it works for grandchildren, but is that child considered your dependent?
Well, his father's still living, but they live with us.
Yeah, I don't think it's gonna work, but I'd sure be happy to look it up for you.
What is the minimum age on that again?
There is no minimum age. There's actually a court case out there, and I haven't heard how it ended yet. And the court case was, it was actually a realtor, true story. It was a realtor who had twins, and they were 3 years old. And he took a picture of the twins in his T-shirt, with his logo or whatever it was, and he paid them a sitting fee. He paid them to be their models. And the IRS is saying, there wasn't services performed. And so it basically goes to the point where your child is able to perform services.
And the maximum you can pay them is, per child is $3,000?
No, it's $5,700 before it's gonna be taxable.
Okay.
But they have to provide services. Now, don't just change their allowance into a salary. They have to perform services. So you wanna make sure they're out there putting flyers on doorknobs or handing out postcards or something like that. So Let me see, vehicle loan interest, even if you're doing standard deduction, or standard mileage rate, don't forget to give your tax preparer your vehicle loan interest. A portion of that loan interest is deductible. Publications, my husband wants to become a realtor just so he can deduct the cost of all his handyman magazines. He would like to be a handyman, he is not one, so he gets every magazine, hoping it'll help him compensate. But don't forget House Beautiful, home living, handyman magazines, anything that gives you ideas on how to either stage a house, fix something easily, those are all deductible, as well as your Gazette and all the other local publications. Home internet though, that's another, like you said, home internet, you can't live without home internet. You've got to be accessible to your office and to your clients now. It's a new world that when some of the old IRS deduction laws came into play, and so they're a little bit more understanding. Yes?
May we deduct food magazines for serving food?
Are you cooking recipes out of there for your shows? Or for your open houses?
Yes.
I would be darn tempted to take it. I absolutely would. I wouldn't go overboard with it. And it, you know, like I said, some of those are gray areas. The food magazine, that would definitely be a gray area. But you get the right auditor. I've actually had very good luck, knock on wood, with the audits I've gone through. Very small changes. And generally, as long as you're not overly aggressive on everything, and you had a good story for it, they'll let you take it.
Are you seeing more leasing of vehicles or ownership of vehicles? And is one better than the other?
Toss up, toss up. And it used to be the taxes really benefited the leasing, not anymore. They put lease limitations on it too. Go for the best economic deal, and you're gonna end up with about the same tax deduction. But no, I have a few clients who trade cars so often though. I mean, every 8 months they're in there for a new vehicle. And so they generally go with the leases. But, I own my cars for 10 years, so I have 5.
For a while there, software, they would ask you how long it was good for or something like that. It seemed like they had some kind of a depreciation issue with software, even though you're using it forever, the same thing. So it should be 100% per year, shouldn't it?
Software, we can section 179 now. Yep, we can take it all in the first year now. And especially software, even before they let us do that, if it was software that you had to buy a new update every year, we always took that every year. So.
I have kind of a strange one, but that might be interesting to those that do 1031 exchanges. My husband and I just took a trip, only a timeshare in Lake Tahoe. So we went to Lake Tahoe, but we looked at property while we were there for a 1031 exchange, and then I also spent time with my realtor friend, a broker friend in California, talking about business because she's thinking about going into management. How would you separate out, because with 1031 particularly, where you're looking for property, you're trying to identify property, how would you deduct on it?
You have a couple issues. One, obviously, I'm assuming there was probably a little bit of a personal element to the trip as well too.
Oh,
Of course. So what we need to look at is what days did you do what activities? We do a proration of the expenses. There's a few little formulas we have to work through. And anything associated with the 1031 is actually added to the basis of your new property. That's not a straight deduction. That's added to the basis of the new property. The referral with the realtor, we could add that to your business deduction, and then the rest of it would be personal.
Complicated, okay.
Yep, it is, but there is an answer and there's a way to get a deduction for it, so.
I'd like to clarify your question on the maximum amount on the children back there. It's actually driven, it's a standard deduction for single taxpayers. We get stuck in 2010 until we do the next tax season. It's actually $5,800 for 2011, just to let you know.
After 18 tax seasons, it takes a little while to get the new.
Yeah, a number goes up a little bit every year.
Yeah, that's kind of the range. Yeah.
All right, let's talk about the flat tax. Eliminate your job and my deductions, right?
It could eliminate a portion of our job, but we do a lot more than tax returns, so. Yeah. Okay. But yeah, it's been around for a long time, they've been talking about it, so. We are down to about 3-4 minutes, does anybody else?
We just, as realtors, we'd like to have equal opportunity, equal show. On your handout, you capitalized Realtor R, but in your PowerPoint, it was a small r, but you capitalized accountant, so we just like to.
That would be Terry's responsibility.
I'll take the bullet for that one any year.
Terry's our director of marketing, so.
I was trying to figure out how to pronounce it, get it correctly.
Okay, thank you for pointing that out, though, in case I use it again.
You can pay lower the social security tax to 13% this year.
Lower the social security.
Yeah.
Oh, yeah,
This year.
yeah, absolutely. I thought that.
Yeah.
Oh, one more.
In that home office, you're not allowed to have any of your personal,
Exclusively business. One court case, it was a small little room off a hallway, and they walked through it to get to the bathroom, disallowed it. So,
Yeah, I do have to say, Rhonda, we go to a tax update seminar, and Rhonda couldn't go this year for some reason, but the guy that gave us our seminar this year was saying they're cracking down on these home offices. If it's not exclusive use, and just like Rhonda said, if you sit down and, do something on the internet personally once, that's not exclusive use.
So you want it to be exclusive.
And to be honest with you, by the time you figure all that, calculate all that up, you end up with about a $100 tax deduction, $200 tax deduction a lot of times. So, pennies count if it's truly exclusive, but.
Joy, did you have something?
Actually, yes.
Oh, perfect. Well, thank you very much. If you have any questions, please feel free to give us a call. We'll be here for a little bit afterwards.